Well, good morning, everybody. The organizers of the conference were really nice to me. They said I can talk about anything that I liked. So here's some of the things that came to my mind. I thought maybe we could talk about the avalanche of regulation, but then I felt maybe early in the morning that wouldn't be such a good thing. Or perhaps Solvency II, my personal favorite. If you want to get onto my board agenda in Munich these days, if you don't talk about governance or Solvency II, you haven't got a hope. But I thought that may also be a little dry. And then there's operational efficiencies, all our companies going through that sort of thing. And I moved into the more esoteric, the probability of Martin Johnson still being the manager of England by the time of the next World Cup, statistically speaking, or one which I thought may have some appropriateness in this circle. Prime Minister Cameron not long ago said people should stay at home and not go overseas. I just went past St. Paul's and it seems that there's a camping holiday as we speak. Weather's not great, but there you go. No, I'm going to try to give you my 30-mile high view of the world. I'm going to look at two aspects only, the what's happening in the global economy, and then talk a little bit about natural disasters and this particular year. So that's the agenda. A little bit about the global economy, then the changing risk landscape, and then some conclusions. So I guess you hear it at every conference that you go to, and I have over my 4 decades in this industry, but it's actually now true to say that key trends and changes are reshaping the world. I'm not going to talk about all of these or even most of them, but on the top right, the regional shift from west to east in terms of economic power in the first instance, and now we see the first manifestations of a shift in political power as well as the Chinese and the Indians and the Russians start to stand up for themselves and say, well, we don't actually want you out of Europe and the United States to lecture to us anymore. We want to partner, but on bilateral basis perhaps, but we don't want you to tell us about how to reduce carbon reduction. We don't want you to tell us how to run our economy or about democracy or human rights or anything else. We want to have those experiences ourselves. And I think it's a significant shift in how the world works. We're going to talk a little bit about the global economy, and we're going to talk about the natural disaster world. I think in the insurance world, the most important challenge that we all face is what I call the challenge of relevancy. Are we still relevant? Are we still part of the solution? And watching these mega trends and doing things about them, and we've heard some of those trends in the first paper in terms of distribution. It's a distribution revolution that's underway in the world. I could imagine a world in X number of years' time where the internet is the basis that people buy all forms of personal insurance. We see those trends in many countries already, and the pace of those changes is very rapid. So this new world, lots of instability. To quote a recent bank advert, the ship denotes the Titanic, and the iceberg is the iceberg, and the ship is sort of going towards the Titanic or to the iceberg, and we're in the middle of a major crisis, the worst global crisis for 3/4 of a century, so get used to the idea of volatility because it's kind of here to stay. So what it's about, what's this global economy about? And let's look a little bit at the European sovereign debt crisis. On the left-hand graph, you see the spreads of government sovereign in excess of the German Bund. So if you go back just to August 2009, not a long time ago, then you would see fairly narrow, fairly tight spreads between the investment return that you would get on a 10-year German Bund versus various forms. And you can see on the right-hand side how that market has basically spread out of control. Obviously, a country can't pay 22%, 23% over the Bund spread to roll over its debt. And this has manifested itself in a revaluation of bank shares, depicted on the right-hand side, the interbank market seizing up to some extent as it did in 2008, with banks sending cash balances to the European Central Bank, paying 75 basis points to do that, as opposed to receiving interest, shows that there's a great deal of nervousness. We have observed a stock market crash and levels of volatility that have not been seen for years. And I can remember 2008, and then before that 2002, 2003, where we saw those kind of levels of volatility, and it's even higher now. So the crisis today is not a Greek crisis any longer. Perhaps it never was. The process of contagion spreads to other and bigger countries and to the banking sector, which stands behind these countries. The similarities between 2008 and now, perhaps one might describe that to say, in 2008 there was a fire brigade to put out some of the fires. In 2011 the fire brigade seems to be on fire, and that's more difficult than to attack the problem. We think that a three-pronged approach is necessary in order to put this crisis in Europe behind us permanently. Consolidation and structural reforms in the eurozone are unavoidable. This is a key part of the message. We need a credible roadmap to fiscal and a degree of political union, however difficult that may be, to address the essential weaknesses in the institutional architecture of Europe. And then we need a strong defense mechanism, some of this announced over this last few days, to shield the euro against speculative attacks, and the Stability Fund with the bond insurer standing behind that. I'm happy to say that that was actually a proposal made by the Allianz Group, by my colleague Paul Achleitner on the board, with the support of us. Now, what does this deal really look like? We get to write down 50% of the face value of Greek debt. That's quite interesting when you consider that under the provisions of Solvency II, one doesn't need to carry risk capital against sovereign risk. So loads of things are going to have to be revisited. There's a bank recapitalization program as part of this deal, very important, because the banks eventually sit with a lot of the problem. It's not a Greek problem. And the leverage of the Stability Fund to take the value of that fund up to around $1 trillion, that's being worked upon. You've read in the paper about trying to attract investment from overseas, including in China. And I've already referred to some kind of political consensus is needed. Difficult as that may sound, there's really no option but to achieve some level of economic and fiscal integration in order to see a future positive structure in Europe. There's some good news, though, because we see already now some signs of stability in the so-called eurozone periphery. And I draw your attention in particular to left-hand top chart, where you'll see the growth in GDP, and in particular Ireland, which seems to be doing a really good job of, as it were, taking the pain and turning the corner. So we see some positive developments. And also on the bottom left side, you see the declining labor costs in these periphery markets, which translated into another terminology would say that price competitiveness is improving in the eurozone, and that obviously stands at the in the way of economic growth. And however one may talk about this European crisis, at the end of the day, or this world economic crisis, at the end of the day, without economic growth, there is no solution. So economic growth, critically important. We see positive signs. We see labor costs going down. Now, across the Atlantic, the situation continues to be interesting and in some respects has deteriorated very significantly over the last few years. This is the US debt to GDP since 1792, so quite a long period of time. And I guess if one were an optimist, which I suppose you need to be today, you could say, well, at least it's better than in the Great Depression. But other than that, it's higher than it's ever been in history. Now, quite clearly, major changes in the US are also required. The tax to GDP ratio is one of the lowest amongst OECD countries, and that's something that may have to change in the US. But as you've seen so far, no major changes, but rather throwing money at the problem, and we'll see how that develops. So to conclude the first part, before going on to a little bit about natural and other disasters, is the crisis over? No, it's not. May not even be halfway through. We see declining growth throughout the world. The US growth rate in Q2 of 1.3%, which is one of the slowest recoveries of that economy since World War II. We see a slowdown also in Asia, very unbalanced growth, loads of issues to think about. Political instability, the so-called Arab Spring uprisings in North Africa and the Middle East, the consequences of which probably mean a further surge in oil prices at some stage, and maybe then a longer-term inflation or decline in prices over the longer term, depending on how economies develop. Sovereign debt, far from over. I've referred to that already. The US number is somewhat sobering, almost $50,000 per citizen as of today, and going up as we speak. Now, to bore down into our industry, why is natural disaster such a big topic today? Well, 2011 was really a very, very onerous year when it came to natural disasters. After a number of benign years, from the first quarter where we saw an earthquake in New Zealand, which completely devastated a city. The estimates at this stage in Christchurch are that 50% of the city will have to be demolished and reconstructed, maybe even a different site. And this for a city of 350,000 people, vast damage involving the global insurance industry. Floods in Australia, the huge earthquake and tsunami in the northeast coast of Japan, and then loads of other events. So far, touch wood, not yet the mega cyclone hurricane in the Gulf hitting a major city, but Irene and tornadoes and now winter storms, some early snow on the east coast, loads of things happening. 2011 is a year in which we as the insurance industry kind of should be doing something about the risk exposure. So what's some of the reasons behind this? Climate change sort of got off the agenda a few years ago with the advent of the global financial crisis, but it's actually on the agenda. And I think it's always quite a sobering picture. In my lifetime, the average temperature of the world has increased by 1 degree, and that's a kind of scary thought, whichever way one looks at that. We think that global warming, which is underway, will cost the world 1% of global domestic product, or gross domestic product of the various countries by the middle of the century. So that will be kind of wiped off the slate as countries have to take actions to protect themselves. Weather-related catastrophes since the 1970s have been increasing at 2% per year. This is just a matter of fact. 5 to 10% increase in hurricane wind speed, which we expect as a consequence of the formation of these superstorms, has the capacity to double the average annual load caused by hurricanes. 200 million people live in coastal floodplains around the world as of today. There's $1 trillion of assets less than 1 meter above sea level around the world. And in the European context, a 1 meter sea level rise, which seems not unlikely over the next half century, perhaps sooner, will put 20 million people in jeopardy and $300 billion of GDP at risk. those sectors of the economy which are likely to be most affected: water supply, infrastructure, tourism, energy, and the list goes on from there. So global warming is back on the agenda. Severe natural catastrophe trends, though, are also on the rise. And we see, I won't go into a lot of detail on the graphs. It shows you the makeup of these natural disasters, and the one which you maybe think about in terms of global warming is the little yellow bit, the part which is affected by climate change. And for the year 2011, for the industry as a whole, there's 265 billion of economic damage as a result of, this is for everybody, not for insurance, 265 billion in economic losses in the first half of 2011. And so that's thereof 60 billion of insured losses. And you need to compare that to something. So compare it to 2005, which was Katrina, which was 220 billion for the whole year, and that was the most costly year in history. So this year has already overtaken that. Just to remember Katrina, there were 1.7 million claims, 156,000 commercial claims, huge numbers when one thinks of back of that event. Now that magnitude event hasn't happened again this year in a highly developed area, but already we've increased beyond the level of 2005. And insured losses have been increasing all the time at the same, over the same period. So the average weather-related claim has risen from the 1970s per annum, so weather-related claims in the aggregate, from around 5 billion to 40 billion in the 2010 to 2019 period. And this is not only, of course, a function of climate change or weather patterns changing, it's also to do with urbanization and so on. In this year, we saw recently in the Insurance Day that some of the numbers for the various losses: 1.2 billion for the Japanese quake, for Swiss Re, for Lloyd's 1.95 billion, Munich Re 3.3 billion during the first 6 months, Berkshire 2.13. So big losses in the industry. And these large losses that we see around the world, they have many facets associated with them. Part of it is, of course, climate change and changing weather patterns, but also globalization, urbanization, developing countries with less robust infrastructures, and then, of course, rapid economic growth, and our ability to model risk being a little slower than the increase of the economy. So loads of things to think about as an insurance industry. World population reached 7 billion, more people age 60 today alive than ever lived in history. Quite nice statistic. I'm 57. I'm quite pleased with that statistic, actually. Hopefully we won't bring down the odds. Despite all of that, the world economic crisis, despite this being one of the heaviest natural disaster years in history, what we can observe in this graph is that it's not reflected in the pricing cycle. Now, this is simply a view of the insurance industry pricing. Since 1971, I've been around for most of these years in the industry, and we can see that there were a couple of pricing spikes. We know what caused those. We know what caused the one in 2001. But what we see for the first time in decades is actually dropping below that 0% mark. So in real terms, premium declining around the world, and that's a real worry given all of these other issues which I've highlighted. Now, the idea is not to go through any more trends, but simply to say that we face loads of important challenges in this industry. We'll talk about some of those hopefully in the panel discussion, but at the end of the day, the insurance industry has actually done very well. And we should remind ourselves, our clients, and sometimes also our regulators and the politicians, that we've done quite well. It's only really been the collapse, the near collapse of AIG, and bailed out by the Fed, by the Treasury, and then the collapse of a company in New Zealand around the earthquake. But other than that, our insurance world has been in good shape. So we think it will continue that way, and the boat will pass the iceberg. Thank you very much.